All right, you
ma'am.
may begin now. Amabel, you may begin now.
So, good morning, everyone. We are the Group 6 market. So, first, we have the brief overview of the global financial crisis. The global financial crisis refers to a wait, ma'am, si Kuya Joshua lay mo share screen kay nilag ang among net.
Joshua. Okay.
So again, good morning, everyone. We are the Group 6 market. So first, we have the brief overview of the global financial crisis. Next, please. The global financial crisis refers to the period of extreme stress in global financial markets and banking systems between May 2007 and early 2009. A downturn in the US and the housing market was a trigger for a global financial crisis that spread across the world. Several banks had a lot of losses and needed government bailouts to survive. Alaysa?
To have a deeper understanding about the global financial crisis, let us identify the main causes of this. So, first, we have excessive risk taking in a favorable macroeconomic environment. So, expectations that house prices would continue to rise led households, especially in the United States, to borrow imprudently to purchase and build houses. Next, we have increased borrowing by banks and investors. So, borrowing money to purchase an asset magnifies potential profits but also magnifies potential losses. As a result, when house prices began to fall, banks and investors incurred large losses because they had borrowed so much. And last is regulation and policy errors. Regulation of the subprime lending and securities was not sufficiently strict. There was insufficient regulation of the institutions that were involved in the MBS market. Many borrowers found themselves having to borrow much more than they could afford.
Next slide, please. So how the GFC unfolded. The US house prices fell, borrowers missed repayments. There had been falling US house prices and the rising numbers of borrowers unable to repay their loans that started around mid 2006. As house prices began to fall, the share of borrowers that failed to make their loan repayments began to rise. So next is the stresses in the financial system. It first became apparent around mid 2007. After many of the lenders stopped making their loan payments, the houses could only be resold at greatly reduced prices. Next is the spillovers to other countries. Foreign banks were active participants in the US housing market during the boom, including purchasing MBS with short-term US dollar funding. This has created problems in the US housing market to spill over to financial systems and economies in other countries, and the failure of financial firms panic in financial markets. Times were tough after the insolvency of Lehman Brothers in 2008. Near failure of several and other banks around that time sparked a global financial crisis. Also, financial markets became unbalanced as everyone tried to sell their assets and no one could obtain funding.
So the government and central banks implemented a policy in order to help recover the economy. It includes lowering the interest rates, increasing government spending, and stronger oversight of financial firms. Next slide, please.
Now we have the relevant economic and financial data. In the first row, we have the unemployment rate. Based on the data, in 2006, the unemployment rate was 4.4%. On December 2007, which is the start of the recession, the unemployment rate rose to 5%, and on October 2009, the unemployment the employment rate hit to 10% for the first time in a quarter century. In the following years, the recession ended and the unemployment rate was declining gradually. 9.3% in 2010, 8.5% in 2011, and 7.9% in 2012.
In the second row, it showcases
Eliza?
the movement of GDP. So prior to the recession, the GDP rate is declining. However, it doesn't reach to a negative growth rate. During During the recession, there comes a negative growth rate, negative 0.1% in 2008 and negative 2.5% in 2009. After the recession, the GDP went back positive with 2.6% in 2010.
So in the third row, it shows the movement of the short-term interest rates. During the recession, the short-term interest rates fluctuate eventually. The Federal Reserve adjusts short-term interest rates to keep the system in balance. After the Great Recession, the interest rates continued to decline. So for the last row, Eliza.
So, lastly, we have the Dow Jones Industrial Average. Before the Great Recession, the DGR reaches 14,164 points, an all-time high. It falls during the Great Recession, a drop of more than 50%. And after recession, it reaches a new record high of 15,650 points. Now I'll give the floor to Hanilu.
So moving on, let's proceed to the overview of the COVID-19 pandemic. So the COVID-19 is a global shock. The spread of the virus has not only been a public health emergency, but it has also had an economic impact on the world. Reduced productivity, loss of life, business closures, trade disruption, and the tourism industry's destruction have had significant economic consequences worldwide. We expect financial markets to remain inconsistent as the virus disrupts economic activity and harms manufacturing and service industries, especially in developed countries. It is still unclear whether this crisis will have long-term structural implications for the global economy or have more short-term financial and economic consequences. In any case, infectious disease like COVID-19 can cause high economic and financial costs to regional and global economies. So to continue, let's hear it from Rhea.
For the relevant economic and financial data. Based on our research, here are some of the relevant economic and financial data before and during the COVID-19 pandemic in the Philippines. So before the COVID-19, the GDP is said to be 6%. 1.8% of the GDP is allocated for public deficit. 37% of the GDP is public debt. Inflation rate before COVID-19 is 2.5%, and the unemployment rate is 5.1%. While during the COVID-19, the GDP contracted by 8.3% due to the outbreak of COVID-19. 7.5% of GDP is public deficit and 48.9% of GDP is public debt. Inflation rate is 2.4% and the unemployment rate is 10.4%. So as for the GDP growth, it measures how fast the economy is growing or shrinking. Comparing the GDP before and during COVID-19, we observed that the GDP is falling. The primary reason for this is a combination of government-mandated lockdowns and voluntary social distancing by businesses and households, contraction in household spending, and lesser contribution of major sectors to the GDP. GDP is also affected by public debt, which is the amount of money government owes to outside debtors, and public deficit, on the other hand, occurs when expenses exceed the revenues. For the inflation rate, we have observed that there is a decline in inflation rate, or there is a deflation or decline of price level of goods and services. The possible reasons for this is having a shortage of money in circulation, wherein, due to pandemic, there is less spending in the country. It can also be because there are more goods produced, but the demand is low, so prices decreases, so the people will buy the product or goods. As for the unemployment rate, majority of employees reported job was suspended, hours and pay reduced, and some were forced to take unpaid leave. There is a great increase in unemployment rate during the COVID-19 pandemic in the view of lockdowns where there are closures in retail trade, mall, airports, canceled flights, and closures of non-food and non-health related manufacturing services with estimated great number of people losing their job. And lastly, as for the forecast, as the world works under the new normal and is expected to live with the virus under safety measures, there is a projected changes in terms of GDP growth, inflation rate, and employment rate for the next few years, given that the economy has to bounce back amidst the pandemic. And these are the GDP growth will be 6.6% in 2021 and 6.5% in 2022. There will be a decrease in public deficit of around 7.1% in 2021 and 6.2% in 2022. There will be a projected increase in public debt of 52.5% in 2021 and 55% in 2022. Inflation rate to remain at approximately 3% and the unemployment rate of 7.4% in 2021 and 6.7% in 2022. Joshua?
Uh, Hello, guys. Can you hear me?
Yes.
Uh, okay. So moving forward, here are the recommendations for stronger and more resilient financial markets. So first, by keeping the banks liquid. Diba during great recessions, there are lots of banking institutions or lenders that goes bankrupt because of borrowers default. So as a result, the credit dries up. So dili na sila makapautang. So business institutions cannot form a capital as well. So this actually disturbs the system of spending, having its great impact in the economy. So that's why in order to have a resilient financial markets in cases of crisis, banks must always be liquid. So they must have always sufficient capitals in order not to distort the economy. So mo gibuhat sa Federal Reserves during great recessions wherein they made a bailout sa mga nakalisod nga banks to continue credit. So as well as encourage people to borrow money. So in short, the central banks must overlook for banks to ensure their liquidity. Second, strict regulations to banking institutions. So if bank liquidity is important, then there is a need to regulate it, of course. So when we relate it to great recessions, ang gibot magud sa banks kay they made subprime mortgages. So napautang sila to people even though they are very risky. So dako kay ang chance nga magka-default. And then there is a very low interest rates resulting to lots of borrowers. So as a result, nagka-default na, leading to financial crash. So in line with this, the government must also have a tight regulations for this. The central banks must always overlook all banking activities to avoid the situations from happening again. So they must regulate bank interest rates as well as kung unsay credit ratings sa ilahang borrowers. And third is we must consider the emerging technologies, so especially in digital currencies or digital banking. So basically, nag-promote financial inclusion, di ba, mga digital banking, and we are really aware of that. So financial inclusion and development of payment systems are very important in making this money available to households and businesses. So most especially in this time of pandemic. So even if pandemic is clearing, still the household spending is not disrupted. And also the financial markets will be digital in the future. So that's as early as now, we must effectively engage with it. And lastly, financial literacy of the household sector. So this is very important. Every households must be literate in financial aspects because as you have observed during great recessions, ang sa sinungdan gato is mga households kay nangutang sila even though they knew that they are not capable of paying it just because low interest rates siya. And as a result, they defaulted and that's a great impact to banking institutions. So in line with this, every households must know the long-term effect of his or her actions when it comes to financial decisions. So he must consider every situation and have insights on what will be the effect. So that's why in order to have stronger and resilient financial markets, each households must be literate enough about these aspects. That will be all, ma'am.
Okay. So one of your recommendations is can we go back to that slide? Financial literacy of the household sector. Now, in the light of what happened in the global financial crisis of 2008, can you give a specific way of applying this recommendation on financial literacy of the household sector? Because you said, no, nga, this is important because those who borrowed or those who had mortgages are from the household sector. Can you give a specific way
Pardon,
to implement this?
I cannot really hear you, ma'am. Pardon, ma'am.
Huh?
Pardon, ma'am.
Okay. One of your recommendations is financial literacy of the household sector. Am I clear now?
Yes, ma'am. Yes, ma'am.
Okay. And then you said that this is very important because the circumstance no of the global financial crisis of 2008 involved household taking out mortgages, right?
Yes, ma'am.
So can you give a specific way of implementing this? How will you make households more financially literate in the light of what happened during that 2008 crisis?
I think, ma'am, they must be careful enough, ma'am, to the long-term effect for that because during great recessions, ma'am, they are lured by low interest rates. So that's why they get mortgages even though they are not capable of paying it. So they must be literate enough. So they must have a perhaps a what do you call this seminars or seminars that can help them to have insights on what will be their effect of such financial decisions. Kaya nahitabo mo gud, ma'am, they defaulted and it leads to bankruptcy to several banking institutions and resulted to a great recessions in the economy.
Okay. Okay. Okay, so you said seminar. So it's more of informing, no?
Yes, ma'am.
Informing
Informing.
the people. Now, I'll give you a scenario. I want to buy a house, so therefore I have to take a mortgage. I know I'm not qualified, but I will apply for a mortgage anyway because the bank is offering it. So how will you prevent that? Because that's really what led to that crisis, no? Kanang these subprime mortgages, which means nga they were lending to people who were not really qualified or who lacked the qualification under normal circumstances. So how will you prevent that? Nga, me, I know I'm not capable of paying it, but the bank is coming after me so that they can lend me that money and take that mortgage. And they're saying, okay ra if you're not so qualified, basta like just take this mortgage. How will you address that?
I think, ma'am, the government must also take part, most especially the central banks, ma'am. So they must impose a strict regulations towards banking institutions. Kanang ganing dili sila magpautang to kanang magpautang with very low interest rates because kadang people or households who are not literate enough for in financial aspects will be anyway they will mangutang guys naman bisag di sila capable. So the government must also take part, ma'am.
Mm-hmm. Anything else from
Something,
the other
ma'am.
members? Yes.
We should check first the background of the client, ma'am, and that the requirements must be stricter. And if ever man gay, ma'am, nga magpa-loan man gid kay kanang gamay lang nga amount nga ila ra makaya and dili lang mo take og advantage. That's all, ma'am.
Mm-hmm. Okay. That's it. No more. All right. Okay, thank you.
Thank you, ma'am.